Ladies and gentlemen, welcome to the 48th Annual New Orleans Investor Conference. It's time to take your seats for our pre-conference sessions, and we're glad you're here. My name is Robert Helms, host of the Real Estate Guys radio program. I will be your master of ceremonies basically from now until late tonight. So let's just get used to each other. It's going to be an awesome start to the conference. Who's not been to the New Orleans Investment Conference before? Who's not? Oh gosh, everybody. Okay, well, thank you for coming. A few of you, welcome back. What we do before the conference starts, which is officially 1:55, is we've got two sessions today that we call pre-conference sessions. And the first time we did a pre-conference session was 10 years ago, and that was awesome. We had 4 presenters and 5 people in the audience. That was our pre-conference session. I can see already that the numbers have increased. So if you've not been to the New Orleans Investment Conference before, I'm going to give you a whole tee-up after Brien Lundin, our host, speaks at 1:55. So we won't belabor this discussion with that, but we'll give you all the ins and outs. You'll feel fully prepared after that session. So the 2 sessions today, we're going to talk, the real estate guys are going to talk about how to short the dollar with real estate, followed by our good friend Adam Taggart, who's going to moderate a session with a bunch of YouTubers to find out what they're thinking about metals and mining and the like. Does that sound good? Yeah. All right, well, let's welcome our first pre-conference session with the real estate guys. Hi. I'm Robert Helms, host of the Real Estate Guys radio program. Thanks for coming. We're excited to be here. I think it's our 12th year. In fact, the presentation we're about to share with you, we did an earlier version of in 2013. Be thinking of that as we show you what we're going to show you. And I will say that the folks that took action in 2013 have likely done extremely well. Now, your results may vary, but we have a lot to share. We're going to kick it off. So first of all, the Real Estate Guys are in our 26th year of broadcast on the radio and tens of millions of downloads. You can find our podcast, which comes out almost weekly at all of your favorite podcast outlets, wherever that may be that you find your podcast. So check us out. We got great guests. We don't just talk real estate. We talk broader picture economics. Almost everyone who graces this stage this weekend has probably been on our show. All right, so with that, the big question everybody has these days is, what does it take to get my clicker to advance the slide? That's the big question. And we have a world-class AV crew, by the way. They've been coming to this thing longer than we have, and that are our good friends at Royal Productions. You're not supposed to call attention to them when they do something inadequate, but that must have been my fault. Anyway, Corey and the team are awesome. You'll see as we get through the weekend. So the big question is the dollar strong? That's a big question, right? How many of you have heard on the news that the dollar is strong? Excellent. How many of you have been to the grocery store? So here to tee up whether the dollar is strong or weak and what that means, please welcome the co-host of the Real Estate Guys radio program, Mr. Russell Gray.
All right, thank you, sir. Okay, I'm excited to be here, and I'm glad that you guys are here. And we have a lot to cover. Robert mentioned we originally did this presentation way back in 2013. And so you're going to want to pay attention because, you know, there's when you're in a room and you hear an idea is only good if it's acted upon. It's only profitable if it's acted upon, I should say. So our motto at the Real Estate Guys has been education for effective action for a long, long time. So this is a graph of what's called the DXY. How many of you know what the DXY is? Okay, it's like they call it the Dixie. It's like this index where they compare currencies against other currencies. And the dollar, as they say, is the cleanest shirt in the dirty laundry. And so this is how the dollar compares in its relative strength. And this is just the last year. So you can see the last year, the dollar has gotten very strong. It's 113 or so on the DXY. And it's part of the reason why precious metals prices are low in dollar terms, okay? I had an interesting exchange with Dr. Mark Skousen. Who knows who Dr. Mark Skousen is? I think he's been coming here since 1976. He was identified or nominated or somehow honored as one of the 20 most influential living economists. And we sent out a promotion for people to come to the New Orleans Investment Conference, and he's on our mailing list, and the headline was, "The Demise of the Dollar." And he sends me this email, "What are you talking about, demise of the dollar?" And I said to him, "Well, Mark, you know, in Wall Street, I see that the dollar is strong, but on Main Street, not so much. You're a lot smarter than me, but that would be an interesting debate to have." This is what he emailed me back. He said, "All currencies," how many currencies? "All currencies are losing value due to loss of purchasing power, but all other currencies are depreciating faster than the US dollar. So the dollar is strengthening relative to other currencies which are falling faster." It's like jumping out of an airplane and the guy that pulls the chute first looks like he's going up, but he's not. Everybody's falling. All right? Now he says what's surprising is that gold is falling in the face of the highest inflation in 40 years. So I'm going to be on a panel on Saturday morning about the future of money, and I have a theory about why that's happening. And I don't know that I'm right. It's just my theory. I'm just a Main Street guy that watches the news and tries to understand. But I'm guessing my co-panelists are going to be a lot smarter than me, and I'm going to put that out there and see what they have to say. So here, just imagine, there's a way I think of it. This is, let's say that we had a ship in the ocean out there. We'll call it the good ship Fiat. And in each, they have bulkheads so that if the ship were to take on water, it's sealed off, right? And so in the back of the boat, you would have the weakest currencies, maybe the Venezuelan bolivar. And in the front of the ship, you would have the most powerful or strongest currency, which would be the US dollar. And so if the ship were to begin to sink, in other words, the currencies, the fiat currencies were going to begin to sink, as Mark pointed out, some are going to sink faster than others. And so this is what that would look like. This is the currency. So Venezuela is underneath the water right now, and everybody is climbing up to the tip of the ship, which is the US dollar. But do you see a problem? You see the movie Titanic? How did it go for the people who thought they were safe at the tip of the ship? Right? The people who made it are the ones who got off the ship and into the lifeboats. In this case, the analogy is the lifeboats are gold and silver. Because when they hit that water line, they have real intrinsic value. Fiat currencies do not. Does that make sense? Okay, so you do have a strong dollar if you look at the world through a Wall Street lens. You have a weak dollar if you look at it through a Main Street lens. Last time I looked, most of us live on Main Street. Okay, and this is what that looks like. This is the CPI for, this is from the Federal Reserve, St. Louis, Consumer Price Index for all urban consumers, purchasing power of the consumer dollar on average. And you can see from the last 10 years, it's been declining, and you can see the last 2 years, it's really declined quite quickly. If you were to flip that over, or if you look at that, it's like literally going off a cliff. You know, the old, as the sun never rises, or as the sun also rises, Ernest Hemingway. How did you go bankrupt? Gradually and then suddenly. That's a little bit of a fall off. So the dollar has been collapsing on Main Street. That's what inflation is, okay? So the long-term trend is clear. You go back to 1913, the formation of the Federal Reserve. As soon as they formed the Federal Reserve, the dollar collapsed. It collapsed. And then they quickly tried to prop it up, and that led to the Big Depression. And then it has been just a pretty clear trend all the way down. Okay, so that's the dollar. So when someone says the dollar is strong, just remember the context, okay? Because we're talking about shorting the dollar through real estate. Why would you bother to short the dollar if you thought the dollar was strong and getting stronger? You got to buy off on the premise that the dollar is weak and getting weaker. So I just wanted to make that case. Okay, the other thing is currency is not money. For you youngsters out there, it used to be that money and currency were one and the same, but that separated in 1964 and then formally worldwide in 1971 when currencies, paper, fiat, was separated from precious metals. Most people at this conference understand that, but if you're new, you might not. This is from a site called Coinflation, and you can look up, and I got this morning, 5:25 a.m., table based on October 12, 2022, says that a quarter made in 1964 or before, from 1932 to 1964, has a face value of 25 cents, but has an intrinsic value, a metal value of $3.48. okay? And you can look that up anytime you want. So think about this. A cost of a gallon of gas in 1930 or 1964 was 30 cents. Cost of a gallon of gas today is $3.92. If you would have taken a silver quarter in 1964 and put it in your sock drawer and taken it out in 2022, it would roughly still buy a gallon of gas. You would just have to convert it into currency to be able to do the transaction. Its face value did not change, but its real value did. You see the difference? Very important you understand that difference. It's the difference between something that's paper and something that's real. That's the point. Okay? And what's interesting about what's going on with silver and what's going on with the currency in general in terms of inflation is that the biggest component of inflation is energy. So energy is way up. So the price of gas is way up. And yet, in spite of that, and this artificially strong dollar in the currency markets has suppressed the price of silver. So silver's rocking around $19 to $20 an ounce. At the same time, oil is way up. And in spite of that disadvantage, a quarter will still buy a gallon of gas. That's how powerful precious metals are in terms of preserving purchasing power over the long term. And another way to look at it, if you go to our friend Dana Samuelson, who's here exhibiting, very, very good friend of ours. We met him here, as a matter of fact, known him for a dozen years. If you were to go to his site and purchase some junk silver, some quarters from 1964, for every dollar, every 4 quarters you buy is going to cost you $23 of Federal Reserve notes or fiat. In other words, your fiat currency has lost 95.6% of its value since 1964. 95.6% of its value since 1964. So when you hear a guy like Robert Kiyosaki say savers are losers, if you're saving Federal Reserve notes, that's what you're up against. If you're saving silver, it's a very different thing. If you keep your savings in gold and silver, you have a very different experience, all right? Things that are real retain their value, paper does not. That's the thesis, okay? So let's talk about housing. Housing is real. Well, here's the price of housing since going back to, I think, 1971. And you can see that there was a little dip there, the 2008 financial crisis, and you can see housing has just gone through the roof since 2020, okay? And if you're concerned about that, if you're one of those people out there holding a bunch of equity in your properties and you're like, oh my gosh, I'm worried that we're going to have another crash, come to our general session on Thursday and we'll talk about how you can use precious metals to preserve the equity in your real estate, because there's a lot of bubble in real estate prices. There's not so much bubble in gold and precious metals prices, and you would learn how to convert that equity on your balance sheet from real estate into precious metals. You probably have a more resilient portfolio. And I think resiliency is a word you're going to want to take up into your investing strategy because we're, in very volatile times. Anyway, let's take a look at rents. So we know that the housing prices have been, a little bit of a bumpy ride, but the trend has been pretty clear, held their value very well against falling dollars. This is rental inflation. Notice a pattern? Same trend. Same trend. Okay, so on Main Street, the dollar has been consistently weak against housing prices and against rents. That's the point, okay? So when you see all these headlines, and I just put in strong dollar today, and I got all these headlines when I did a search that talk all about the strong dollar, you just have to tell yourself, okay, that's fake news, because when I go to the grocery store, when I do my budget, it tells me on Main Street, the dollar's not strong at all. And so, what you think and believe affects what you do, and what you do affects the results you produce. If you believe that the dollar is strong, you're going to have a strategy. If you believe the dollar is weak, you're going to have a different strategy. If you believe a stock is going to go up, you're going to buy it and go for the ride. If you think it's going to go down, you're going to want to short it. And so we're going to talk about that in just a little bit. The point is, now you understand, okay, inflation is real, the dollar is falling against things that are real, just proved it over the long haul. There might be little times when it should, but the trend is clear. So now the thing is real estate the right vehicle? And so when you're looking at inflation, you want to get into things that are real. Real estate is real, precious metals are real, energy is real, commodities are real, agriculture, those are real things. What is real is you cannot just conjure them out of thin air. They can print money, add digital add digits electronically and just expand their balance sheet. The Fed can expand their balance sheet and all that kind of stuff. So at the end of the day, what you want to get your hands on are things that are real. Convert your fiat into things that are real, and then that way you preserve. So we're going to talk about real, in particular. I'm bringing Robert back up, and he's going to explain to you kind of the way real estate works. I know this is a resource and metals conference, but you want to get into understanding real estate, and then I'll come back and show you the numbers.
Russell Gray, ladies and gentlemen.
Thanks.
All right. Welcome, some of you that just got here. You're late. We started at noon. No, it's perfectly fine. This is a pre-conference workshop. So what we love about real estate, it is unique as an investment. And it's unique in a lot of ways. You never, ever have to own an ounce of silver, a barrel of oil, a share of stock. You never have to buy those things, but you cannot sit out the real estate market economically. You don't have to buy a house, but you have to interact with real estate from a financial perspective. So like a commodity, real estate is real. It's tangible. You can touch it. Like a precious metal, it's durable. Things like energy, they get spent and they're gone. But all the gold that was ever mined is still in humans' hands today. It's the same with real estate. Now, you've also heard they're not making any more real estate at our cocktail party Friday night. I'll show you how that's not true. Like food, it serves a basic human need. You can't get by without food. You can't get by without a place to live, a place to work, a place to vacation, a place to go conference. And like a business or a bond, real estate, held for the production of income, rental property produces income, cash flow, and it keeps up with inflation, kind of along the lines of our topic. Like an option, it provides leverage. But I would say with a lot less downside, you won't get a margin call with real estate, and you can actually get more leverage. And like a mutual fund, you don't have to manage it. You don't have to be the day-to-day manager. Now, you can if you choose to. If you want to own a rental house and decide who is going to move in and go paint the walls when it's empty and all that stuff, you can, but you certainly don't have to. Also, real estate provides longer, safer, fixed leverage than any LEAP. Now, who knows what a LEAP is? Who does not know what a LEAP is? Okay, well, no investor left behind. A LEAP is an options contract that's over a year, but usually less than 3 years. So these are vehicles that people use in the marketplace. You also don't have frequent rollovers of your leverage. You can refinance certain real estate, not all real estate, but generally residential 1 to 4. You can refinance if you need to. Russ will talk about that a little more later, but you don't need to. And you also get incredible income tax breaks. Our friend and best-selling author, CPA Tom Wheelwright, says if you want to understand what a nation wants its citizens to do, read the tax code. And the incentives we get are based on taking financial actions, and one of the best places to save on your taxes is real estate. We often give Peter Schiff a bad time about living in Puerto Rico half the year. Not that it's a bad place to live. Some of you may live there, but it's like, dude, you know, you don't have to move to Puerto Rico if you buy real estate. Because as real estate investors, we don't pay very much tax. Perfectly legally, by the way, because our government wants us to invest in clean, safe, affordable housing for other people to live in. Also, you can defer your gains in many cases a long, long time, even indefinitely. So real estate is unique because of that. Real estate's also diverse. We talk about real estate. When you hear the news, they're usually talking about single-family home prices. But real estate encompasses houses, apartment buildings, mobile home parks, care homes and group housing, student housing, self-storage, retail buildings, office, medical, industrial, warehouse, hospitality, and resort like we're in. So there's lots of different ways to invest in real estate. It's not just little green houses. Now, real estate does have a very simple business model. I don't know about you, but I own some stocks for which I'm not 100% sure what the company does exactly. I mean, I have an idea, but when it comes to where is their profit center, and I just don't, I get lost on that. I remember owning Cisco back in the days, and like, I'm not sure what they do, but everyone else seems to be buying it. Real estate's simple. People live in your property and pay you rent. Let me do that again. People live in your property and pay you rent. Or they vacation in your property and pay you every night. or they office in your building and pay you office rent. It's a simple, simple model. It's one of the greatest things about real estate. You don't have to be a rocket surgeon to be a real estate investor. Now, real estate is more than just the rent, though. There's four primary ways we make money in real estate. Number one is cash flow. That's when more money comes in than goes out every month, and we like that. Number two is depreciation. That's the tax benefit that we get for owning property. Number three is amortization, which we don't really think about of a way to get wealthy, but it is, because every month that your tenant pays your mortgage payment, that's who pays it, not you. Most of that payment at the beginning is interest, but a little bit is principal. And every month, that principal is more of the unit, the house, the property that you own. So amortization does build wealth over time. And then probably the big one, appreciation. You saw the chart earlier about real estate pricing. You'll see another one of those before we're done, but appreciation. Now, there's an added benefit that I didn't talk about, and that is what we call lifestyle investing. Some real estate is real estate you want to go stay in and vacation in and hang out. If you're interested in that topic, if you want to know who would like to have a vacation home that pays them to own it, you can go visit, you can stay there, but you can get paid to own, and we'll come to our workshop on Thursday so we can share that with you on Thursday evening. It says 5:45, I don't know if that's the actual time, but it's Thursday upstairs. Come find us and we'll talk about that. And when you come Thursday, we'll also invite you to the legendary Real Estate Guys Party, which we've been doing here for now 10 years. It started in a little hotel room, it went to a suite, and it keeps getting bigger. Virtual year, we did it virtually. In the words of Russ Gray, it was awesome and it sucked. All right, now let's talk about what it means to short. We talked about shorting the dollar. To do that, please welcome the shorter co-host of the Real Estate Guys, Russell Gray.
All right, thank you, sir. All right, I feel like you ever watch those old wrestling shows where they kind of tag back and forth, so now it's my turn in the ring. So, again, Robert talked about no investor left behind, so let's just get into the definition of shorting. I mentioned it earlier, I want to go through it one more time because sometimes, you use these terms and people are like, I don't quite get that. So from Investopedia, and you can look it up yourself, in short selling, a position is opened by borrowing shares of a stock or other asset like a dollar that the investor believes will decrease in value. Because we tend to denominate everything we do in dollars, we have a hard time thinking about shorting a dollar because we think the dollar is fixed, but it isn't fixed against things that are real, right? That's what my first part of the presentation was all about. So the investor then sells those borrowed shares to buyers, or you trade them in the marketplace for something that are willing to pay the current price. So if I can pull future dollars, if I can borrow money and purchase a property today, say a $120,000 property, 10 years from now, and that property's $240,000, my debt stays the same. Does that make sense? So effectively, I've shorted the dollar, and I'll show you the math on that in a minute. Before the borrower shares must be returned or repaid, the trader is betting the price will continue to decline against things that are real, meaning the price of the property would go up in dollars, right? When the dollar declines, real things go up in dollar terms. But that doesn't make you any richer. That just means you stayed even. And I'll show you that in a minute, too. Remember the quarter? The quarter didn't make you richer. It just meant you could still buy a gallon of gas in 2022 for the same relative wealth that you could do it in 1964. You're not richer. You just didn't get poorer. So the first order of business is not to get poorer, but shorting allows you to magnify the benefit of the inflation or the effect of the inflation to become richer. How many of you would like to have investments that outperform inflation? That's how you get richer. Most people have jobs and wages that are underperforming inflation and they're getting poorer. Or they hold dollars in savings or in interest yielding assets that are producing less than 8% or 9%, whatever inflation is today, they're getting poorer. So first order of business is to preserve your purchasing power, but the next order of business is to actually build real wealth, okay? So that's what shorting is. So now we're going to do some math, and I want to go through the scenario with you. So track with me. I mean, this is just small numbers. You can add zeros if this isn't sexy enough for you, whatever you want to do. It works with apartment buildings. It works with industrial parks. It works with shopping malls. It works with, in anything that you've underwritten and you feel like the market dynamics are there and the economic dynamics are there. But I'm just going to use real simple math. You go buy a property for cash. You pay $120,000 because you don't like debt. Now you've converted your fiat currency into something real, a house. And the utility, the real world value of that house is it sleeps 3 people. Now, that $120,000, if you didn't buy the property, you could use it and buy 6 $20,000 cars. Let's say cars are $20,000 on average in a market where you could buy a house for $120,000, right? You're laughing at that, cars being 20? Okay, well, laughing at houses being 120, right? Okay, so they're just numbers. You just want you to get the concept, okay? Or you could trade for 60 ounces of silver at $2,000 an ounce, okay? So this is just, what you're trying to do is think outside the dollar. You say, my $120,000 is worth a house, it's worth 6 cars, it's worth 60 ounces of gold. In this case, you decide to buy the house. You with me? Okay. Now, 10 years later, at an average annual appreciation of 7.2%, the rule of 72, most of you are probably familiar with as investors, means it'll double in 10 years. So that $120,000 house could be worth $240,000. Anybody that's lived in certain markets goes, it took that long? Like I'm in Gilbert, Arizona, and houses doubled in 3 years. But let's just say it takes 10, because that's kind of the average. So now, in that future 10 years from now, that house that went from $120,000 to $240,000 still only sleeps 3 people. In real world value, it didn't go up. But the $240,000 now, you could trade for 6 cars, but the cars doubled. Now they're worth $40,000. In other words, you preserved your ability to buy 6 cars, but you didn't improve your ability to buy more cars. Does that make sense? You could trade for 60 ounces of silver if gold had doubled to $4,000 each. So in other words, you preserved your purchasing power by parking your money in real estate. You take it out and you can go buy the same things you could have bought 10 years earlier because you didn't stay in dollars. If you would have stayed in $120,000 in the stock drawer, you come out and buy the cars, you'd buy half as many. If you come out to buy the gold, you'd buy half as much. Just like if you put your dollar or your quarter, your non-silver quarter in your sock drawer and bring it out to buy gas, you can't buy it. It had to be real. It had to be silver. Making sense? Okay? Very important you understand this. Okay. So you're not really richer, you just didn't lose. Okay, but our goal is to get richer. We're going to get richer by shorting, because preservation is not progress. Guys trying, right? Do you ever feel like that when you're running your portfolio? Trying to outpace inflation and taxes and regulation? All right, so let's play the hand differently. Let's say you take the $120,000 and you could buy 1 3-bedroom house for $120,000, or you could buy 6 cars for $20,000 or 60 ounces of gold for $2,000. We've already established that. But let's say we do this. Let's say we take that $120,000 and we make 3 $40,000 down payments on not 1, not 2, but 3 houses. So now we have 3 houses, same $120,000, $40,000 down payment, which is like a third down. We're going to go get an $80,000 loan. So we're going to get 3 $80,000 loans. And so now we control 3 houses, 3 tenants, 3 sets of income, 3 tax breaks, all that. And our balance sheet on the right-hand side there, we have $120,000 of equity, the same as if we would have paid cash for only 1 house. We have $240,000 in debt, which is being serviced by the tax breaks and rental income of the property, and we've locked our cost to debt in for at least for the 10 years, maybe even for the 30, okay? And we control $360,000 of real estate. Everybody with me so far? This is not rocket science or rocket surgery, as he says. And here's the principle. Leverage magnifies inflation and increases what I call your equity growth rate. You can see in the first column, you have a $500,000 property. If you were to put $250,000 down, you would get $250,000 in financing. You control 2 parts of property for 1 part of equity, which means you have 2-to-1 leverage. If that property appreciates 5%, it's 5% of the $500,000 or $25,000. But the $25,000 on the $250,000 of equity you put in means you got $25,000 of new equity, which is a 10% equity growth rate. Get the math? Again, not complicated. If you were to buy a $750,000 property with the same $250,000 equity, you would have to get a $500,000 loan. And your leverage ratio would be 3 to 1. You would control 3 parts of real estate for 1 part of equity. If a property appreciated that very same 5%, or the dollar fell against real estate by 5%, because at the inverse, it's the same thing. It goes up in dollars, or it goes down in terms of the dollar falls by an equal amount, okay? So you've got 5% of 750 is 37.5, or 15%. So if you know your leverage ratio is 3 to 1 and you've got a 5% appreciation, your equity growth rate is 15. If you were to buy $1 million property with that same $250,000 and use $750,000 of financing, now you're in at 4 to 1. This is a 25% down payment. You know, in terms of real estate buying, most people buy, you know, put 20%, 25% down. That's pretty standard practice. Nobody really considers that to be really extreme, irresponsible leverage these days. That's kind of how you get started in the game. And everybody knows if you don't get started in the game, inflation will take the price of the real estate faster than you can save, unless you're one of these people that have super high incomes. All right, so $1 million, 250, 750 debt. Now you're in at 4 to 1. You get the same 5% appreciation. That's 5% of $1 million, or $50,000. $50,000 on your 250 is 20%. So if you go into a paper asset world and you talk to people about 20% growth rates on a portfolio, they think that you are really, you're crazy. That's really risky. That 20% must be really risky. And this is only one of the 4 ways that Robert described that you make money in real estate. This is just the appreciation. But we've magnified the inflation on the real estate to our benefit by using debt. That's effectively shorting the dollar. Okay, so let's go back and look at the scenario based on this principle. Now, each of these houses is worth $240, and the debt we fixed at 80. And in this scenario, in 10 years, we didn't pay a penny down. We didn't build up any equity by paying the loan down. We have the same loan balance 10 years from now that we did the day we took it out. But because the properties have doubled, your equity went from 40 to 160. Because you got all the equity, so 240 minus 80 is 160. Got it? And then you did that times 3, so when you go to the right, what you see is you've got $480,000 of equity and $240,000 of loan balance on a $720,000 real estate portfolio, just 3 properties. Okay, so now let's go see how that really looks. That $480,000 is 4 times more money than you put in. You 4x'd your money in 10 years. Okay, so now that 480 at today's price would buy you 2 houses for $240. It would buy you 12 cars at 40, or it would buy you 120 ounces of gold at 4,000. In other words, by introducing leverage, by shorting the dollar, we doubled our wealth. We didn't just preserve it. Inflation 2 times it, but leverage or shorting the dollar 4 times it. And we did it using debt, and the service on the debt, which is why everybody's so afraid of it, was handled by the income and the tax breaks on the property. So you've doubled in real terms. You've doubled your purchasing power in real terms. Even though the cars went up twice, even though the gold went up twice, your purchasing power went up 4 times, so you could buy double. Okay? That's the way it works. So what about those mortgage rates? Guys have heard about that? I didn't highlight this, but you can see right there at the tip, this is what we just experienced in the last year, the fastest rate of mortgage rate growth in probably 20, 30, 40 years. And so that's very painful. Okay, but the point is that historically the rates are still pretty low. Oops, sorry, rookie mistake. The rates are still pretty low, okay? So what you do is you have to think about the different scenarios. It's like playing chess. If I make this move, then what? If I make that move, then what? And so let's do that. Let's say, based on today's high mortgage rates, you go get a mortgage. What if rates go up? How is your mortgage, your 30-year mortgage, going to look if rates go up to 10 and you've got 7? If they go up to 12, how's it going to look? Pretty good, right? You're going to be happy you have a mortgage and a property. Now, the property value might drop, but remember the rents? Rents are pretty steady. Rents really index well to inflation historically. Who knows what's going to happen tomorrow? Maybe this time it's different. I'm not saying it isn't. There's risk in all investing. All I'm saying is that if you don't fix on the price, a lot of people, they fixate on the price. But if you just focus on the trend and put yourself in a position from cash flow to be able to control the property, you'll see in a minute that as long as you can stay in the game for the long term, at the end of the day, the inflation is going to win, okay? So if rates go up, you're going to be glad you have today's low rate. What if rates go down? If rates go down, what is likely to happen to the price of the property? It goes up. And if you own the property, that's equity happening to who? You. And then if rates go down, can you redo your financing? How many opportunities do you have to buy the property? One. How many times can you refinance it? Right, so as the interest rates move around, you can restructure your portfolio. As you begin to pay your loan down or it begins to appreciate and you start to lose your leverage ratio, optimizing equity says go in there and borrow more out and then maybe use it for a down payment on a property, use it to purchase some precious metals to separate the equity. I'll teach you how to do that at the main stage tomorrow, okay? But the point is whether they go up or down, there's a scenario where you're going to be happy. What if rates remain the same? Well, then if it cash flowed and everything's fine. So, but what if you don't buy the property? What if you don't buy the property and 10 years from now it's worth twice as much? What happens to you? Nothing. Nothing, okay? Here's the history of rent inflation since 1940. You can see pretty smooth. There was a period after the GFC, the Great Financial Crisis, where it flattened out, but pretty much the trajectory has been clear since 1940. In the last 10 years, you see that big crash after the 2008, where that yellow button is, the yellow bubble is? Oh no, wait, rents didn't crash. They flattened, okay? So when you hear about people all freaked out about real estate in 2008, if you're focused on cash flow, if you're focused on properties that rent and balancing the rent against your debt costs, then you're okay. Because here's the thing. If you look at this chart and say, well, I'm sure glad I didn't buy any real estate in 2007, which is right there, because you would have had to endure all that, but you wouldn't own the property here. Real estate is a long-term short of the dollar. It allows you to take dollars from 10, 20, 30 years in the future and spend them today based on the idea that they are going to continue to print more and more dollars, diluting its value in real terms, and everything real is going to cost more in dollars. If all you do is buy gold, if all you do is buy real estate for cash, if all you do is buy collector cars, artwork, whatever you're buying, you're going to preserve your wealth. But to short the dollar, you got to use debt. And to use debt, you're going to have to use the best debt available, and you could make the argument that's real estate. So Robert's going to come up and talk to you a little bit about the 7 essential investor resources, and then we're going to get you out of here. Thank you very much.
All right, that's Russell Gray, co-host of the Real Estate Guys radio program. This is great. Every time I come up here, there's more people in the room. Just like my real estate rental cash flow. Every time I look at it, it's more. So let's say you've decided, you know, this sounds like a good thing to do. How do you buy real estate? 2 primary ways, active or passive. Active, you find the deals, you find the tenant, you do the work, you paint the shutters, you do it all. Passive is, I'm not even sure where all my real estate is. Now that's a big continuum. Some of us are more active in the selection of our property, the markets we pick and the types of properties we like, and then we find a professional management team, and we'll talk about who's on your team here in a minute. But don't feel like you have to go out every weekend and spend your weekend in your real estate. You absolutely do not. So we talk about the 7 essential resources as an investor for our financial. Cash, cash flow, credit, and equity. Cash is pretty easy. It's easy to count. You can look in your account and see how much you have. Cash flow is what's coming in from various investment vehicles that you have, including your job if you still have one. Credit, how credit worthy are you, which is going to be important if you're going to want leverage. You're going to borrow against your real estate. You're going to have credit, or somebody on the team is. And then equity, as Russ showed, what happens over time is equity increases in your portfolio. I love the word equity. It's the part of the real estate that you own. Now, the other essential resources are also critical: time, talent, and relationships. Someone needs to have the time to research the markets, find the best opportunities, make offers, deal with attorneys and CPAs. That might be you, or it might not. Talent is where you come in. Either you have the talent or you find the talent. A lot of people come into the real estate door through the trades, people who are good at construction or painting or interior design. Some people come in through brokerage or through lending, and some people just want more real estate that goes up in value and provides more and more cash flow with tax benefits. So you decide how much of your talent you're going to use. At the very least, you have to be talented enough to pick a good team. And then real estate, like most investments, is a relationship business. And this is a great conference to forge new relationships and strengthen ones you already have. So we'll talk about that here when the conference kicks off. But those are the 7 essential investor resources. Your mission as someone considering real estate is to decide, which of those do I have and which of those do I need? If you have all 7, awesome, but most people don't. Some people have more time than money. When you have more money than time, you appreciate people that have more time than money, right? There can be a great cooperative situation brewing there. So those are the resources. How do we deploy those resources? Through a team. Together, everyone achieves more. Who is on your team? Well, we think of it as your home team and your away team. Home team are people that are near you. That's your accountant, your bookkeeper, your tax strategist or CPA, a mortgage consultant maybe, a credit coach if your credit isn't where it needs to be, your insurance agent, equity, an entity or equity strategist, 2 different things, and then mentors in your mastermind are all near where you are. And then the away team is where the property is. Wherever the property is, you're going to need professionals there. You're going to need a broker. You may need an insurance agent licensed in that state. And certainly real estate attorneys are licensed by state, and property managers are always close to the property. So your mission as a real estate investor is to build these folks. Now, sometimes you'll be able to invest passively in something called a private placement. We've got several awesome folks that do that who will be in the exhibit area tonight at the cocktail party, and you can get around and meet them. Some of them are hosting meals and those kinds of things, and that's where somebody else does almost all the work. They found the attorney, they found the broker, they found the property, they put together the management team. Not that different from mining operations. You're not out there swinging the pick or the hammer. You bring a team in to do that. It's the same thing here. So if you do it yourself, you're going to assemble this team. If you're going to leave that to other folks, then you just want to make sure all the boxes are checked. And it takes a while. It takes a while to assemble a great team. Sometimes you need a new team member. A lot of folks we meet, they have an accountant that they've liked, and the more they become advanced in investment, the less they like their accountant. Not that the accountant's a bad person, but because they maybe don't understand the intricacies and nuances of the investments that the client is making. So if you advance and develop and your team doesn't, sometimes you got to trade out your team members. So just take an honest look. Who do I have now? Real estate brokers. Love real estate brokers. They're different in different areas of the country and the type of real estate. A commercial real estate broker is not the same as a residential real estate broker, who is not the same as an industrial broker. So depending on the type of real estate. What you do want is to find a great broker that you can be loyal to. The person that says, oh, I got half a dozen agents working for me, has none. All right, so another place to learn about real estate and all kinds of cool stuff is our annual Investor Summit, and you can learn more about that at our booth. Our 21st annual summit is coming up, and we haven't even announced any of the faculty, although you can see some of the folks that have been with us in the past. Peter Schiff's been with us 10 years, Ken McElroy 10 years, Kiyosaki 8 years, Brien Lundin I think 6 years. This will be his 6 years. But anyway, come and check that out. If you want more information, just summit@realestateguysradio.com.